This is Chuck Carnaval. I'm the Chuck in the Markets Up Chuck. And as my blog post today pointed out, the fear mongers have risen again, and they're trying to scare everybody and all kind of dire news. We had a bad unemployment report, and the market was off, terribly on Friday. And that's the normal volatility you're going to see with the market. But one of the things that people are also trying to talk about is how, since the market has risen so much, that the rise is actually over. And I want to put that all into perspective using our fundamental research analyzer tool. And I want to first start by looking at, quote unquote, the market through the eyes of the S&P 500. And what you have here is a 15-year chart in the S&P 500. The blue area represents the earnings per share at the normal price-earnings ratio, which has been historically accurate for the last 25 years. I might point out somewhat skewed by the overvaluation you had during the irrational exuberant period from the mid-90s up into 2000, because if you look 80 years, the S&P 500's average PE has been about 15. But the point I want to make is this: when you're looking at this picture, the perspective I want to give you is this. The black line is monthly closing stock prices. There was a period here where the market was being ridiculously overvalued, and it eventually corrected to the mean. The last recession brought the excesses that we had here back down to normalcy. But here's the point I want to focus on. When you look at what happened to the market after the last recession, because earnings had fallen so much from 2001 into the, or during the year 2001, then the following 4 or 5 years, from the beginning of 2002 all the way 2006, what you see here is a very strong earnings, which is actually just the S&P coming back to more of a trend line growth rate of 7 or 8% or so. During this 15-year period, we have about a 4.5% growth rate on the S&P 500, but I want you to notice that the price correlates to earnings as they always have. Now, this is one of the most severe recessions that we've had in a long, long time. As you can see, earnings have collapsed, so stock prices have fallen dramatically, and if you go back and look at some future blogs, back in February, the S&P had actually fallen to under 700, and now we've rallied from 700 up to the 896, plus or minus, number that we have now. But the point I want to make is, first of all, this is not that big a rally, even though the percentage is rather large. Because it's coming off of such a low number, it's really not that great. I would argue very strongly that the S&P is now coming back to normalcy and is reasonably priced today. Not necessarily real cheap like it was back in February, but reasonably priced. Now, the reason I still expect to see good growth going forward is the recession is, beginning to end. I talked about in the blog. There's an awful lot of reasons to say that we're finally coming out of the recession. It doesn't mean all the problems are over. It doesn't mean things are going to be great. It just simply means that we're going to start seeing some, return to more normalcy over the next year or 2 or 3. But one of the things that usually occurs there, just like it did back in this period here, is when earnings have gotten so low, then coming off of such a low base, you're going to get some very big, high percentage increases year over year coming for the next year. In fact, the forecast for next year on the S&P right now is for 17% advance, which would be, 4 times what its historical average has been over the last 15 years. But that's just getting back to its normal earnings power. So there's a lot of reasons to believe that the general market environment over the next 4 or 5 years are going to be good based on valuation. Volatility will always be there. When you've had an advance like this, just as you had in any other period, you're going to see some corrections. The market goes straight up and then it'll correct a little bit. It's always a ziggy line, but the point is valuations right now make sense, and that's the general market. So let me now move on, and let's take a look at some individual companies and look at how they're valued, because as I've always pointed out, I believe the individual companies are more important than the market in general. I'm going to go through this quickly, as I always do, but just to point out some real opportunity. Here's St. Jude Medical, a company that's had, very, very consistent earnings growth. You can see the market has generally overpriced this stock for most of the, late 90s into the, most of the mid 2000s. Then it kind of got reasonably priced, actually got cheap, and then the price, rallied back. This is still a very reasonably priced stock today, given that any time you buy it on this line, you would have made a lot of money in the future. And it does have a very, very bright future going forward. I wanted to contrast that with Strayer Education, a company that by my definition is overvalued today, even though the market's been so horrible. This company's trading at 32 times earnings. It's a 15 to 20% grower. You can see the prices correlate that growth rate, but there has been, even in this recession, the stock remains massively overpriced. It was ridiculously overpriced, at the end of 2008. It did have a correction, but it's now rallied back. And this is one I would avoid only because I think the valuation is too high. I think it's a great company. I think it has a lot of potential, but I don't want want to pay 30 times earnings today, when, as I'll show you here in a moment, I can buy a lot of other companies growing, very fast at much lower valuations. Now I'd like to move on to a stalwart, the great Coca-Cola company, one of Warren Buffett's, great holders. I want to point out with this picture how important valuation is. You can see this is the earnings growth rate. It's been about a 7.8% grower over the last, 15 years. That makes it a stalwart. It pays a nice dividend yield, over 3%, and the dividend has increased year after year. But I want you to see where the market had it overpriced, dramatically into 98, and then there was very poor performance. And then, when the stock got reasonably priced, however, those are times when you want to buy companies like this. When you look at Coca-Cola today, at least based on its, on its historical normal valuation that the market would put on it, with a nice dividend yield of a company of this quality, this company's on sale today. Don't let fear, frighten you from looking for names like, great names like Coca-Cola that are on sale today. Then my last example will be Procter & Gamble. With all the fear and everything else, you can see Procter & Gamble's gone through the recession very, very well. This is simply an estimate. The last recession we had in 2001, it held up very well. This is a, star. Everyone knows who Procter & Gamble is. But the point is, there was a period where it got overvalued. Valuation is so much more important than all the noise we're hearing about the economy and, all the other stuff that people are focused on. But as you can see, here's a 15-year chart. This company has never been this cheap. This is a terrific time to be buying this stock with a decent dividend yield, very similar to Coca-Cola. You're buying a great company on sale, significantly below to what the market normally capitalizes at. And as investors, if we're looking 3 to 5 years out, as we should be, you got to expect the economy is eventually going to get better sometime in that period of time. Earnings are going to go back to normalcy. I talked about how lean inventories are, how companies have really got themselves in position to bring money to the bottom line as business improves right now. And this is a terrific time for long-term investors, as long as we don't let fear, keep us from making good decisions. Remember, fear is the foe of the fattest, but the friend of the fundamentalist, because when markets are fearful like they are today, you can really pick up some great buys for long-term gain. This is Chuck Carnival. Don't let the current market scare you. Look forward to talking to you again tomorrow. Thanks for listening.